Hello and welcome to CAP STRAT this week. In this video, we'll be checking in on inflation. We just got a recent reading of PCE, the Fed's preferred measure of inflation. So we'll take a look at that and talk about whether or not a great rotation may be coming within equities. So with that in mind, let's get right to it. Checking in on equity returns for the week ended March 1st. You can see another strong week for global equities. A lot of green here on the board. Anything to note from a 1 week return perspective for equities?
From a 1 week return perspective, not so much, but really want to focus in on the year to date and then the 1 year and how this 1 year is going to evolve over the next month or so. And basically year to date, what's happened has been a continuation of a lot of the equity trends we saw last year. There's been volatility, but by and large, it's large growth stocks leading the way. And within there, it's the Magnificent Seven.
Right.
And we've highlighted quite a few times in our videos and with clients that the Magnificent Seven really started to break away from the rest of the equity market around mid-March 2023, when we were dealing with Silicon Valley blow up and Signature Bank and so on and so forth. And it was mid-March through July 2023 was when the Magnificent Seven really went peak AI boom type stuff. That's going to start falling right or entirely in the 1 year look back, right? We're going to get, as we get here to mid-March and early April, this large growth number is going to get bigger, especially relative to some of these smaller cap numbers and the value numbers. You're going to start to see this separation is already huge. It's actually most likely going to start to get even bigger and widen out in the trailing return numbers.
Yeah, interesting. Mm-hmm. Interesting. And kind of expanding on that point a little bit further, the difference between large growth and small value. I mean, you mentioned it. It's already large, right? A 41% delta over the past year, and a continuation here over 11% year to date. That was something we wanted to dive in further on, is the comparison of large growth represented here by the NASDAQ 100 relative to small value. And to your point, Mike, since last March, I mean, you can just see this significant increase to now where over the past 1 year, you've got 49% outperformance from large growth.
Right. And so we're looking at the NASDAQ 100, a little different from what we were showing on the prior slide. It's more concentrated, more top heavy. The Magnificent Seven, there's something like 50% of this index, right? And as we go through history, the NASDAQ 100 hasn't been around this entire time period. It was launched in 1999, so we're using a proxy before then. But what you see is, the timeline of our framework, which goes back to the 1960s, we're already at sort of the fourth largest outperformance of mega cap growth stocks versus, we use small value, but really it's relative to small caps and value stocks, right? It's more than just the small value area of the market. The fourth largest, we put this red line here and another red line. Those are 95th percentile and 5th percentile bands. We're talking about a multiple standard deviation event. This, in theory, should almost never happen, right? But it has happened, and the last time it happened was 2020, right? So it's been happening quite regularly, actually, in the last handful of years. And how this played out as we got through COVID in 2020, if you look at that last big peak in the NASDAQ 100, it got unsustainable. It got top heavy. The market was looking for a catalyst to rotate into the cheaper areas of the equity market. And at that point, it was in 2020, and it was the vaccine news. And then furthermore, it was the sweep of the Democrats in presidency and Congress. And those catalysts together kicked off a rally in smaller cap and more value-oriented stocks to the point where we flipped from one extreme to the other extreme in the course of about 6 months. Right? Those large growth stocks underperforming smaller, more value-oriented stocks by over 25% after that rotation happened. So we're getting back to that point where, in our view, the market is looking for a catalyst to rotate out of these extremely expensive, very concentrated names at the top of the index into something that's cheap. And we have some ideas on what that catalyst might be and when it might happen.
Yeah, absolutely. I mean, obviously this chart is a little bit bumpy, but it is, you can see when we've gotten to these levels, it has turned around somewhat quickly and very significantly, right? Even here as well. And so think that brings us to, what that rotation could look like, what that catch-up potential looks like, and what those catalysts could be in terms of making that rotation happen. And so what we're looking at here is just maybe a little bit different lens to look through in terms of different performances, where now we're looking at valuation factor percentile ranks. So this is more forward-looking, reflecting recent performance. But I mean, you can see here, no surprises. NASDAQ 100 ranking here, in the 75th-ish percentile valuation factor rank, compared to small value here, much more attractive, right around the 25th percentile valuation factor rank. So,
right. And so we're seeing within our investment framework, the valuation spread is almost as large historically and percentile rank-wise as the one-year return spread.
Yeah.
That actually wasn't the case in 2020. It wasn't as large of a spread. Yes, small caps were cheap, but actually large growth stocks were somewhat cheap as well.
Yeah.
Right? So this is a larger spread. So in our view, there could be an even bigger rotation here. And then something else to note, when we're looking at valuations, what we're talking about is the long-term trend return of the asset class. Are you above that trend or below that trend? If you're above the trend, you're expensive. Below the trend, you're cheap. We're also looking at momentum.
Yep.
So rising or falling. Rising is better than falling, generally speaking. And then lastly, we're looking at the valuation relative to cash, the yield you're going to get on cash over the next 12 months. Because anytime you value an asset, you should do it relative to the risk-free rate, right? And what you see is something interesting for the NASDAQ 100 or large growth. You actually see the valuations getting less awful here recently. That's all due to momentum.
Momentum picking up, yeah.
That is 100% momentum. So if that momentum breaks down, this could feed on itself.
Right.
Logically, you would say, well, if NASDAQ 100 sells off, all right, that means large growth stocks are cheaper, the valuations look better. But actually, momentum is the primary swing factor right now. If these stocks lose their momentum, they're going to look near the 100th percentile of expensiveness, right? Compared to smaller, more value-oriented areas of the market, which are hitting our cheap signal, which historically is a very good leading indicator. Not the best timing tool,
right,
but a good leading indicator of returns over the next 12 months.
Yep. Yep. So we're sitting in this position, you highlighted the comparison or the contraction with 2020, right? But, one of the factors that we think will enable this great rotation is the Fed pulling it off, essentially, right? The Fed being able to have maybe a bumpy landing, soft landing, maybe even immaculate, but getting us to a point where investors will be excited about equities. And what we're pointing out here is maybe there's not much more room to be excited about the NASDAQ 100, but that could facilitate the rotation into small cap stocks. So if the Fed pulls off this monetary policy shift, and then we could see Russell 2000 value stocks picking up relative to the NASDAQ 100. So checking in on that, we mentioned at the top of the show, PCE, we got an updated PCE report last week. Inflation seems to be cooling down okay, right? We had that January report where we had a big month-over-month pickup. But what we're looking at here is if we take into account longer-term time horizons in terms of recent inflation reports, this is a pretty smooth decline to sitting around maybe even south of 2% as we get into late 2024. What's going on here?
Expectations this year have changed so much already because of how volatile the inflation reports have been. The underlying inflation dynamics, something we've talked about numerous times on video, and then the market's willingness to price in 6 rate cuts to 3 rate cuts, right? Taking anything and just running with it. And so the January PCE report was hot. On a month-over-month basis, if you annualize it, it was in the 5% range for core PCE. So that's obviously way too hot. Similar to the January CPI report. Way too hot on a month-over-month. And the services side of the inflation basket, also too hot. But you have to take a step back. Our view was that all of those dynamics would mean the Fed was still going to cut in 2024, just later than the market was originally expecting. Heading into the year, the market was pricing in rate cuts at the January FOMC meeting, and certainly at the March. Now, March is off the table, and the market has moved towards our view of June, July. So you have to take a step back, look and say, January you might have to take with a grain of salt in terms of the inflation data. It's always volatile and cyclical. As we get towards July, so 6 readings out from here, what are these various rate of changes for core PCE going to be running at? Because this is the Fed's preferred inflation gauge.
Right.
And by our forecasts, they're all going to be running below 2.25. And if inflation over a 3-month, 6-month, year-over-year time period, core PCE is running below 2.25, many of the nearer term gauges running below 2, and your target is 2, there's no reason to keep the Fed funds rate at 5.25
Right.
to 5.5. They're going to, in our view, the Fed is going to look at that as an opportunity to normalize policy, adjust policy.
Right.
Even if they're concerned about maybe inflation picks back up to 2.5, 3, there's still no reason why you would have to keep the Fed's funds rate at 5.25 to 5.5, right? So we've talked about this first half of the year playbook versus second half of the year. Until the Fed actually starts cutting, markets are vulnerable. Cash yields are attractive. But if we get towards June, July, the inflation dynamics sort of come down with our trend. The Fed is able to formally end the fastest rate hiking cycle in history and start a cutting cycle. And the economy's still in good shape. The labor market's still in good shape. That, in our view, would be an environment for a rotation.
Yep.
It would mark, in our view, an end to the economic environment that we've been in for about the past year, year and a half. Actually, you could say all the way going back to March 2022, where pretty much only a handful of stocks could perform well and operate in that environment. Right? On a year-over-year basis, the Magnificent Seven, their earnings are up 50%. The other 493 stocks in the index, their earnings are down year-over-year by 3.5%. There was a select few companies that could operate in this environment because they benefited from an AI boom. If that environment switches to an environment that's much more conducive, that could be a catalyst for the rotation. And you think back also previously when an election has catalyzed a rotation within the market.
Right.
It's when those big policy changes are on the table, right? Things like tax cuts, things like tariffs. Companies that are larger, get more of their revenues from overseas, they could potentially be in trouble compared to smaller cap companies that are far more domestic in nature.
Yeah.
Right. So there are a lot of reasons to suggest as we get towards the back half of the year, the smaller, more value-oriented areas of the market are sort of a coiled spring, and there could be some catalysts for a rotation there that we're going to want to participate in.
Yeah. Yeah, absolutely. So we not only have the valuation factor we talked about, but you have some of these macro, global exposure factors where small caps, as you mentioned, more exposed to the domestic economy, things like tariffs that could hurt foreign economies. But also, we talked about the Fed. They're kind of ahead of the curve, globally speaking. So the Fed is the closest to being able to pull this off, which could be another feather in the cap of small caps relative to large caps, which are more exposed to foreign economies. So we take all this into account, and another green week for fixed income as well. I mean, especially, the further out you go from a duration perspective, more positive returns. Is this the market digesting that message of, okay, January was hot, but the Fed's going to be able to look through that. They're still going to be able to cut mid-year at the end of the day.
Yeah, that was our take on the data. The January CPI report was the hot surprise. And there have been some reasons why we've had to take that report with a grain of salt, particularly around owner's equivalent rent versus primary rent. And then when the core PCE prices data came out later in the month, they were hot, but not as bad as feared.
Right.
And then you mesh that with the Fed speak since, and it looks like most voting members are willing to sort of take January with a grain of salt in terms of the inflation data, look past it, and maintain a cutting bias this year just later than expected. So you take all that, and what you see is bond yields start to stabilize, come down a little bit. So, that environment isn't one where bonds within our framework look extremely attractive relative to things like cash, but they don't look unattractive either. It's a far more benign environment than we had, early 2022 for sure.
Right.
Yeah.
Right. Awesome. All right, well, let's get into the other factors of the framework. We talked, a little bit about inflation forecasts, how those appear to be, coming down to around that 2.25%, 2% level by mid-year. Some other good news on the liquidity front as well. Liquidity projections continue to increase. What's driving the biggest increase there?
So we added another month to our data. We got the official January money supply data. So we factored that in and extended out our forecast horizon a month. And what's starting to happen is sort of what we're thinking is going to be happening. If the Fed can embark on a reasonable cutting cycle down towards long-term target rate of the Fed funds rate, every time we add a month onto this liquidity forecast, we're going to be rising.
Right.
And we could have a slow march up to something more like, a 5-6% money supply growth environment, especially if you factor in that the Fed's balance sheet runoff is likely to stop this year. So the liquidity, unless the Fed actually has to hike, which the bar for that is extremely high.
Yeah.
And unless they can't stop the balance sheet runoff, the liquidity situation is probably going to get better and better.
Yep. Which,
once again, will be a catalyst because the Magnificent Seven apparently don't need liquidity.
Right.
At least in 2023, they didn't. In 2022, they weren't very magnificent. They were down 47%. Let's not forget that. And it seems like they really needed liquidity. But, recently, this rising liquidity environment, we think that also could benefit the rest of the market and be part of that rotation narrative.
Yeah. Mm-hmm. Yeah. And similarly, in line with that, from an economic growth perspective, year-end GDP projections continue to climb as well. Mm-hmm. Is that being driven by the liquidity picture, the Fed policy changes?
Yeah, and just the resiliency of the data.
Yeah.
We're really hopeful. I guess how you say it, cautiously optimistic. If the economy hangs in there, the labor market hangs in there. You see that in our recession signal. You look at initial jobless claims, they're now at their 52-week low. If you change the seasonal adjustment factors to something more reasonable, which is what we look at, which is just, it's beyond any expectations given the news flow, the job cut announcements. So if the labor market hangs in there, the economy stays resilient, and the Fed's able to cut in the back half of the year, we're cautiously optimistic.
Sounds good. Yeah, we've got, the calming inflation picture, liquidity and economic growth continue to improve. Recession signal remains inactive. Mm-hmm. More to come throughout 2024. That'll do it for us for this edition of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.